Imagine this. You've worked for decades, paid into Social Security your entire career, and now it's finally time to collect. But here's the twist. Two people who worked the same number of years, earning roughly the same amount, could end up with tens of thousands of dollars difference in lifetime benefits. Why? Because one of them knew the right strategies and the other didn't. By the end of this video, you'll know exactly how to be the first person, the one who squeezes every last penny you're entitled to from Social Security. And I promise, some of these tips are the kind most people never hear until it's too late. Number 1. Understand how your benefit is calculated. Before you can maximize Social Security, you need to know how the game is scored. Your benefit isn't based on your last job or even just your recent earnings. It's calculated from your highest 35 years of earnings, adjusted for inflation. If you worked fewer than 35 years, Social Security fills in the missing years with zeros, and those zeros can drag your average way down. For example, if you only have 32 years of work history, that means 3 years of zeros get added in. Even adding a part-time job for a few extra years can bump up your lifetime average and increase your monthly check. Think of it like a batting average. You want as many good years in your lineup as possible. Number 2. Know your full retirement age, FRA. Your FRA is the age when you can collect your full benefit. For most people retiring now, it's between 66 and 67. Claiming earlier is tempting. You can start as early as age 62, but here's the catch. Your monthly check can be permanently reduced by as much as 30%. If your FRA is 67 and you start at 62, you'll get smaller checks for life. On the flip side, waiting until age 70 boosts your payment by up to 24% compared to FRA. For example, if your FRA benefit is $2,000 per month, waiting until 70 could mean getting around $2,480 per month, and that higher payment stays for life. Plus, it grows with cost of living adjustments. Number 3. The power of delaying benefits. Here's a secret that could mean hundreds of extra dollars per month. Delay your benefits past FRA. For every year you wait between your FRA and age 70, your benefit grows by roughly 8%. Imagine you're 66 with an FRA benefit of $1,800. Waiting until 70 could increase that to about $2,376 per month. Over a 20-year retirement, that's an extra $137,000 in lifetime income. This strategy works best if you expect to live longer or if you have other income sources to cover the gap in the meantime. Number 4. Coordinate with your spouse. Married couples have extra opportunities to maximize benefits. If one spouse has significantly higher earnings, the lower-earning spouse may be eligible for spousal benefits worth up to 50% of the higher earner's FRA benefit. For example, if John's FRA benefit is $2,400, his wife Sarah could collect up to $1,200 per month as a spousal benefit, even if she never worked outside the home. Couples can also stagger their claiming times. Sometimes the lower earner starts benefits earlier, while the higher earner delays to maximize the eventual survivor benefit. Number 5. Don't forget about survivor benefits. If you're widowed, you may be able to collect survivor benefits as early as age 60 or even 50 if disabled. The amount depends on your spouse's earnings record and when you claim. For example, if your spouse's FRA benefit was $2,200, you could receive up to that amount as a survivor benefit. Sometimes it makes sense to take survivor benefits first and delay your own until it grows larger, then switch later. Number 6. Keep working if it makes sense. If you claim Social Security before FRA and keep working, your benefits could be temporarily reduced if your income exceeds a certain limit. In 2025, if you earn more than about $22,320 before FRA, Social Security will withhold $1 for every $2 you earn above that. Once you reach FRA, there's no earnings limit. You can earn as much as you want without reducing your benefits. And the extra income could replace lower earning years in your 35-year calculation, boosting future checks. Number 7. Be strategic with taxes. Yes, Social Security benefits can be taxed. If your combined income, that's your adjusted gross income, plus non-taxable interest plus half your Social Security, exceeds certain thresholds, you could pay tax on up to 85% of your benefits. For example, if you're single and your combined income is over $34,000, or married filing jointly with over $44,000. You're in the taxable zone. Planning withdrawals from retirement accounts strategically or using Roth accounts can help reduce taxable income and keep more of your benefits. Number 8. Use cost of living adjustments, COLAs, to your advantage. Every year, Social Security benefits are adjusted for inflation. But here's what many people miss. COLAs apply to your benefit amount when you start claiming, not before. If you delay claiming, those adjustments still apply to your future, higher starting point, which makes them even more valuable. Example: if your benefit at FRA is $2,000 and COLAs average 2% per year, delaying until 70 means your higher benefit gets multiplied by those increases, compounding over time. Number 9. Avoid costly mistakes when claiming early. One of the biggest regrets retirees have is claiming too early without running the numbers. Many do it because they fear Social Security will run out, while the trust fund has issues, even. In worst-case projections, benefits would still be paid, though at a reduced level. By claiming early, you lock in a lower payment for life, and you may also reduce survivor benefits for your spouse. Think long-term, not just short-term. Number 10. Check your Social Security record regularly. Errors happen. Employers might report the wrong earnings, or a year of income might be missing entirely. If you don't catch these mistakes early, you could lose out on benefits. Log into your Social Security account online each year and make sure your earnings are correct. Fixing a mistake from decades ago could mean hundreds more per month in retirement. Number 11. Consider the break-even point. When deciding between claiming early or waiting, calculate your break-even age, the point at which waiting pays off. For example, if claiming at 62 gives you $1,500 a month and claiming at 67 gives you $2,100, you'd need to live about 12 years after 67 to make delaying worth it. If you're healthy and have a family history of longevity, waiting often wins. If not, earlier claiming may make sense. Number 12. Use Social Security as part of a bigger plan. Social Security should be one piece of your retirement puzzle, not the whole picture. Combine it with savings, investments, and maybe part-time work to create a sustainable income stream. Example: someone with $2,000 in monthly Social Security plus $1,500 from investment withdrawals can plan spending more comfortably than relying on Social Security alone. Number 13. Understand the Windfall Elimination Provision, WEP. If you worked for an employer who did not withhold Social Security taxes, such as certain government jobs, your Social Security benefit might be reduced under the Windfall Elimination Provision. This can come as a nasty surprise if you are not expecting it. For example, if you receive a pension from non-covered work, your Social Security formula changes, often resulting in a lower benefit than the standard calculation. Knowing this ahead of time lets you plan better, and in some cases, you can reduce the impact by earning more years in Social Security-covered employment. Number 14. Know the Government Pension Offset, GPO, if you receive a government pension from work not covered by Social Security. Your spousal or survivor benefits could be reduced by the government pension offset. The GPO can cut those benefits by 2/3 of your pension amount. Example: if your government pension is $1,500 per month, your Social Security spousal benefit could be reduced by $1,000. Understanding this early allows you to explore alternative strategies for income. Number 15. Take advantage of benefits for divorced spouses. If you were married for at least 10 years, are currently unmarried, and are age 62 or older, you may qualify for Social Security benefits based on your ex-spouse record. This could mean a higher benefit than your own, without affecting your ex-spouse benefits. Example: if your ex-spouse FRA benefit is $2,500, you could receive up to $1,250 per month if that's more than your own benefit. Number 16. Claim benefits for dependent children. If you have dependent children under age 18 or under 19 if still in high school, they may qualify for benefits when you start Social Security. In some cases, even adult children with disabilities may qualify. For example, a retiree receiving $2,000 per month could also receive an additional benefit for a dependent child, which can be a significant boost to the family's income. Number 17. Understand the family maximum. There is a limit to the total amount a family can receive from one worker's record. usually between 150% and 180% of the worker's full benefit amount. This is important if multiple family members will be collecting benefits based on your record, such as a spouse and children. Example: if your full benefit is $2,000, your family's total monthly payout might be capped at around $3,600. No matter how many eligible dependents there are. Number 18. Move to a state that does not tax Social Security. While Social Security is not taxed at the federal level for many retirees, some states do tax it. Relocating to a state that does not tax Social Security can help you keep more of your income. For example, Florida, Texas, and Nevada do not tax Social Security benefits. If you live in a state that does, moving could mean hundreds or even thousands more dollars each year. Number 19. Avoid triggering Medicare premium increases. Your Medicare Part B and Part D premiums are based on your income, and if your income crosses certain thresholds, you will pay more. This is called IRMA, the Income-Related Monthly Adjustment Amount. Large withdrawals from retirement accounts in a single year could push you over these limits, eating into your Social Security income. Spreading withdrawals over several years can help you avoid this surprise. Number 20. Consider filing and suspending. If you reach FRA, you can file for Social Security and then immediately suspend your benefits. This allows your benefit to keep growing while making you eligible for certain spousal strategies. It can also let you restart payments later at a higher amount. Number 21. Be aware of foreign work credits. If you worked in another country, you may still qualify for USA Social Security benefits through a totalization agreement. These agreements allow you to combine work credits from both countries to meet eligibility requirements. This can be especially valuable for people who spent part of their career overseas. You now know more than most people ever do about maximizing Social Security. But the real key is this: the best claiming strategy depends on your health, your marital status, your work history, and your other retirement income. What works for your neighbor might cost you tens of thousands of dollars. So, which of these strategies do you think would make the biggest difference for your retirement?